Welcome to FT Video. I'm Martin Wolf and I'm here with Gavyn Davies, FT blogger, to discuss one of the most important themes in the world economy, which is debt and debt sustainability. In fact, the FT is launching a tool to analyze debt sustainability, which has become a huge concern of policymakers across the world. So Gavyn, let's consider where we are. When you look at all the discussion about debt, leverage and now deleveraging, how worried should the public be about what they're seeing?
I think they should still be worried, Martin. Certainly by 2008 there was too much debt by common consent, especially bank debt and unsustainably packaged products that were packaged in ways that were not in the end sustainable. Since then there's been some delevering in the US and some in the UK, some in the financial sector. There's been
mainly in the private sector, in fact.
Mainly in the private sector. The public sector has actually taken on some of this debt. So in the developed world, I would say there's been some progress. But of course, what we've seen in the emerging world is private and public, but particularly private debt, has been growing very rapidly.
So if we think about this situation at the world level as a whole, how could it end up? I mean, should we be expecting a rash of defaults? Should we be expecting inflation? Private sector collapses, another round of financial crises? What are the sort of worries that there should be if you look at the global level, and if so, where?
Well, I'm less worried than I was about the US and actually the UK. I think they're getting their leverage under control, and also they have some pretty good nominal GDP growth at the moment.
Absolutely, and they have complete control over their interest rates.
Exactly.
And they're borrowing essentially in their own currencies, which makes a big difference.
Exactly. What you've pointed to many times, Martin, is the excesses of bank credit that have developed over the last decade or 2 decades, way above nominal GDP, taking wealth up alongside debt. So I think there are 2 areas that you've pointed to in your book. One is the peripheral Eurozone, which doesn't have satisfactory nominal GDP growth and still has very high levels of both public and private debt. They've been capped, they're kind of stable, but only at the cost of very slow GDP growth. And the other one is China.
So if we look at the Eurozone chart, we can see it here, essentially we've got it at really astronomical levels, close to 400% of GDP overall. Very small declines now being observed, but essentially it's stagnant. So the vulnerability remains constant. If we look there, could you actually imagine that some of the governments, some people mention Greece, will actually have to restructure their debt?
Well, I would have thought Greece still looks like a very likely candidate for further restructuring, and it probably is in their interests and also in the Eurozone as a whole's interest that they do that. I see little point in having a 30-year workout of a debt problem, which leads to continuous recessions, political issues, political problems, and then doesn't work. And I think that's the path they're on in Greece. Maybe not elsewhere in the Eurozone.
But they do need a return to growth, don't they? Isn't that an absolutely crucial thing, and we're not really seeing that yet?
No, so that they've capped the debt ratio, but by doing that, they have also removed the growth rate in the economy to almost zero. And we're not seeing, I think, yet enough from the ECB to recognize the danger of this juxtaposition of continuing high levels of debt with very low nominal GDP growth.
So real vulnerability there. Now let's look at China, which obviously is a gigantically important country. Here's a country which responded to the crisis by promoting domestic demand. And so it imported, as it were, the Western disease, namely credit explosion. They had an enormous credit boom. So this is where they are. You can see after 2008, exactly then when they started to respond to the crisis in the West, their exports collapsed, or export growth stopped, their current account surplus collapsed, and then they offset this with this huge incredible explosion from 140% of GDP to 220% of GDP, while nominal GDP growth is really falling, largely because real growth is falling. Also, inflation is becoming quite low. Is China really possibly the next country for a huge financial crisis, or will they manage it?
Well, we're seeing a property crisis already. I mean, clearly a lot of that debt went into the property sector, which has peaked out, and we're now seeing some pretty important collapses in property prices in parts of China. They started the Xi administration started a year ago with the intention of stopping this increase in the debt ratio. But they found the slowdown in GDP was bigger than they expected.
Yes.
And actually, I think
surprising that they were surprised, to my mind, since it was so obvious what a huge role credit growth was playing.
Exactly.
It was new to them, of course.
Exactly. And actually, the credit growth was getting less effective at stimulating GDP growth, which you can see.
Which we, of course, found too.
Which we found too. And that's a bad sign, I think. So they have to do something about this, but they're only willing to do it if they maintain growth at around 7% or 7.5%. And they found this year they couldn't do both. So they've actually now slowed down the debt workout in order to maintain the growth rate. And I think this is going to take a very long time. They may soft land it, but over a decade.
But isn't there a danger that even to sustain 7% growth, given their situation, they might actually have to need another credit expansion?
Well,
and then it really does get bad.
What we're seeing recently is they are trying to re-expand credit in the property sector. They've become so concerned about real estate and housing that they're trying to get the banking sector to increase lending again in that sector. But they're trying all at the same time to curtail lending to local government. So they're capping the local government debt problem that has been a big part of this recent explosion.
Let me just ask one final question. Do you think many people would say at the end of all this, given that we can't deleverage easily, we're bound to get inflation? It may take a very, very long time, but it's really the only way we'll ever get rid of this immense overhang we now have almost everywhere.
Maybe, Martin, but it's hard to get inflation in this environment. Every time we see any sign of inflation, 3 months later, it's peaked and it's on the way down again. Lately, global inflation has been falling. I think it will result in something different, which is very low interest rates for a very long period of time.
So we're in a global balance sheet recession, in essence, one way of thinking about that.
Yes, but it's not as bad in the United States as it is in parts of the Eurozone and China, and I think we need to be aware of that.
Well, at least there's one piece of optimism, and as always, we can hope for the American locomotive, and with luck, that'll just get us through. Thank you very much.